Did you ever stop to wonder what would happen if your bank went bankrupt? I mean, think about it. A bank's a business, right? Some businesses are well managed, they're making money, everybody's happy. Um, some businesses, not so much. Maybe the CEO's a schmuck and he runs the business into the ground. It could happen, right? And if you're like most people, you don't have any idea who's in charge of your bank. Quick, who's the chief financial officer of your bank? I don't know. Yeah, and that's normal. Nobody knows who runs the bank. They don't know what kind of financial shape their bank's in. They just kind of with blind faith, they just take all their money and they just put it in there. Which, if you think about it, is kind of nuts. Unless there's something there to protect you, and fortunately in the United States there is. There's an independent federal agency called the FDIC, which stands for the Federal Deposit Insurance Corporation. What do? Well, it's an insurance corporation. They insure the banks. Who pays the FDIC? Well, the banks do. The banks pay premiums. The banks pay insurance premiums just like you pay insurance premiums on your car insurance. The banks take a portion of their profits and they put it into the FDIC, and it just kind of goes into this common pool in case a bank goes bankrupt. Now, of course, banks are heavily regulated too, so there are strict rules they have to follow about what they can invest in. How does a bank make money? If you put some money in there on deposit, it's kind of remarkable. The bank, not only do they give you your money back, depending on the type of account, a lot of the times they'll even give it back to you with interest. Plus, they have to pay for the branches and they have to pay for the customer service and the website, and the bank's really doing a lot of services for you for free. Not even for free. They're paying you. They're giving you money and they're providing you services. Banks are kind of unique like that. Most places, if you want a service, they keep your money. With a bank, they're providing you a service and they're giving you your money back and they're paying you extra money. How do they do that? Well, what they do is they take the money that you have on deposit and they reinvest it. And that's where they can get into a little bit of trouble. What if they make bad investments? But the FDIC is there protecting all the deposit accounts. Now, mind you, those are just deposit accounts, meaning a savings account, a checking account, a money market, a certificate of deposit, stuff like that. The FDIC does not insure mutual funds, does not insure stocks. If you buy stocks and the stocks go down, tough luck. But if you've got just money on deposit, that's typically going to be insured, provided that your bank's a member of the FDIC, and I think pretty much every bank is. The way the FDIC works is they insure you, the customer, up to $100,000 per institution. So if I've got $100,000 on deposit at one institution, it's totally insured. No matter what happens to that bank, I know that I'm getting that money back from the FDIC. And if I've got another $100,000 at another institution, that's also separately insured. Furthermore, there are different kinds of ownership categories. For example, if I've got an individual account with just my name on it, and I have a joint account with somebody else, those are both insured separately. So I could actually have $200,000 at the same institution. I've got $100,000 in my own name, and I've got $200,000 in an account with my joint account holder. Half of that $200,000 is mine, so that's $100,000 plus the $100,000 I have in my own name. That's $200,000. It's all fully insured at the same institution. You can also have what's called a revocable trust. A revocable trust, it sounds like something complicated, but basically all it means is that it's a special type of bank account where if something happens to me, if I die, then the money's going to go directly to somebody else. Typically, you'll see the letters POD, payable on death, or ITF, in trust for, and I can list multiple beneficiaries. They have to be qualified beneficiaries. I think they have to be children or grandchildren, or they have to be somehow related to you. But if you've got, say, 3 qualified beneficiaries, that could be another $300,000 that I've got insured. $100,000 for each beneficiary. So I've got $100,000 in my own name. I've got $100,000, which is my half of the joint account I have with my joint account holder. Plus, I've got another account that's got $300,000, but that's in trust for my 3 qualified beneficiaries. And I can also have an individual retirement account, an IRA, which is separately insured up to $250,000. So if you think the FDIC only insures you up to $100,000, there's a lot of ways around that. Just by playing with the account title or by spreading it among multiple institutions, you can protect yourself. Now, I know what you're thinking. You're thinking, Sean, this sounds like a big government bureaucracy. Now, if my bank goes under, I know my money's insured, but it's going to take me a year and a half to get my money, right? I mean, I got to go through all this government red tape. Well, fortunately, the FDIC is on top of that, too. When a bank starts to get into trouble, fortunately, it doesn't happen all of a sudden. They kind of see the signs. They're like, this bank is not looking so good. So when a bank starts to get into trouble, the FDIC, they start shopping around, looking at other banks who might want to buy that bank's portfolio. Now, of course, they're not going to pay full price for it because it's not the greatest portfolio. But maybe if they can buy it at a deep discount, and the FDIC kicks in a little bit of money too, hey, it might be a good buy. So generally what happens, if they can find a buyer, they line that all up ahead of time, and if your bank goes under, the other banks all lined up, and they just step right in, take over the operations, and you as the consumer won't even really see a hiccup. And it's only in a worst case scenario that the FDIC would actually have to send you a check, if they couldn't find a buyer at all. Basically, you're pretty well covered.